Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Okay, for today, we are in Islamic risk management class. Okay, for today, we want to cover one of the initial topics for the Islamic risk management. Okay, risk and Islamic risk management. So, in this topic, okay, what we will cover, I have made some lesson plan. Okay, so first we go for the lecture, okay, which will cover overview of risk and risk management, systematic and unsystematic risk. What are the difference between systematic risk and also unsystematic risk, and also risk management in Islamic perspective, whether Islam allow the practice of risk management, and if they are allowed, how they manage risk management, particularly in Islamic financial institutions context. Right, and then we will have class activities and also online assessment. Okay, in order to evaluate your understanding. Okay, first let's take a look at the overview of risk and risk management. Okay, how we define the risk. Okay, in conventional finance philosophies, okay, Pale 1997 define risk as a reduction in firm value. Okay, reduction in firm value due to changes in the business environment. When there is a changes or anything happen to the business environment, it will affect the firm value. This is according to the Pale is considered as a risk. While the Regavan 2003 defined risk as a perspective of its finance as financial risk or uncertainty of financial losses. Any uncertainties that will brings to the financial losses. Okay, so risk, we can conclude that risk is actually existence of uncertainty about future outcome. We uncertain about the future outcome and difference between expected and the actual result. What we expect and also what are the actual result. That is something that uncertain. We cannot predict. Alright. How we define the risk management practice? Okay, risk management defined by the Oxford Dictionary for Business and Management as a process that aims to help organizations to understand and evaluate and take action on all their risks. When we define the risk, and then we have to manage. How we manage? According to Oxford, is we have to understand, we have to evaluate, and we have to take an action. Okay, based on Islamic Financial Service Board, they identify 5 methods or 5 guidelines in order to manage risk, whether in a business and also in Islamic financial institutions. The first is identification of the risk. Before we mitigate or before we manage the risk, the bank, they need to identify what are the risks, what are the categories of risk that are exposed by the bank. Okay, when they already identify the different category of risk exposed by the bank, they have to sort based on the priority, which risk that they need to mitigate first, and how it affect the bank performance or the bank values. Okay, when they already identify, they need to assess the risk. Okay, the effect of the risk to the firm, whether they give a huge effect or whether they give only a minimal effect, they have to sort based on the priority so that they can focus which one they need to mitigate first. Okay, when they already assess different categories of risk, as we know in a bank, they are exposed to different categories of risk. For example, credit risk, market risk, liquidity risk, counterparty risk. Okay, for the Islamic banking, normally they are facing with the Sharia non-compliant risk. That is all the different categories of risk that faced by the bank. That's why they need to identify every single risk that they are exposed to. And different banking institutions, they have a different degree or different level of risk exposure. Okay, when they already assess the risk and they need to prepare a plan how to mitigate these risks that they already identify at the first stage. Okay, they need to list down the plan, what they need to do, what are the tools or what are the instruments that they need to use in order to mitigate risk. Okay, when they already have a plan, proper plan, okay, and also approved by the top management of the bank, so they need to implement. Okay, they implement the plan that they have done in the third stage. When they implement, so they need to monitor, of course. When they implement, they have to monitor the implementation process and how this implementation helps the bank to reduce or to minimize the effect of the risk to that particular bank. They need to monitor. Okay, and that's why in a bank they have a specific department that specifically manage the risk of the bank, because they need to monitor risk that is posed by the bank, how it's affect to the bank. Okay, when they already monitor, they implement and they monitor, and then they need to review and update risk plan. They cannot simply use the same plan for the whole year, okay, or a few years. They cannot simply use that particular plan, but they need to review based on the current condition of the bank. Sometimes maybe they more exposed to the credit risk, and maybe next year they are more exposed to the due to the economic condition, okay, or market problem, though maybe they are more facing in the market risk, because that's why they need to update and also review the plan that done in the third stage, in order to make sure that this plan are suit with the current condition of the bank. Alright, so nature of the risk. Okay, we can categorize the nature of the risk under two broad categories. The first is systematic risk, and the second is unsystematic risk. Okay, so what does it mean with the systematic risk and also unsystematic risk? Okay, systematic risks are caused by external factor. Okay, risks that are caused or due to the external factor, for example, uncertainty in the financial conditions, business cycles, economics, uncertainties, legal reforms, epidemics, or financial crisis. And these risks cannot be eliminated by diversification. As previously, when we talk about risk, of course, the famous quote for the risk is, don't put your eggs in one basket. We need to diversify. But for the systematic risk, since they are due to the external factor, so the diversification is not the main the main solution in order to manage systematic risk. While for unsystematic risk, okay, risk that associated with the internal factors, okay, affect or due to the internal factors, for example, weak control system failure, or excess debt or fraud. This is an example of unsystematic risk, and these unsystematic risks can be eliminated by the diversification. So diversification is actually one of the solutions that can help bank in order to manage or minimize the effect of unsystematic risk. Okay, that is the difference between the systematic risk and unsystematic risk. Alright, let's take a look at the different categories of risk. Okay, so we can divide it into two broad wings, which is non-financial risk and financial risk. Okay, in a bank, they are exposed to the financial risk and also non-financial risk. How we define financial risk is anything or any uncertainty that due to the financial activities. Okay, as we know, the main activities of the bank is managing the financial. Okay, manage the financial elements. So any risk that related with the financial activities is considered as a financial risk. For example, liquidity risk, how liquid the bank in terms of cash, in terms of instrument of investment, okay, credit risk, market risk, that is under the category of financial risk. While the other categories is non-financial risk, which is risks that are not related with that are related with other than financial activities. For example, IT system, human resource risk. Sometimes staff of the bank also make a make a mistake in terms of sometimes the bank facing with the IT system, because now we know all the bank's activities are rely on the system. Okay, some legal activities, securities activities. This is all categories under the non-financial risk. Right. So how the Islamic perspective, how the Islam looks at the risk management practice, whether Islam allow or Islam prohibit the practice of risk management. Okay, so as based on the Surah Yusuf, verse 67, okay, they said that, "Oh my children, do not enter the capital of Egypt by one gate, but go into by different gates." This is the main point, where the Yusuf, in the Surah Yusuf, they said to his children that do not enter the Egypt only using one gates, but use a different gates, showing that they need to diversify, okay, in order to minimize the risk. They should not focus, okay, only one gate. So when we relate with the Islamic banking context, the Islamic bank should not focus or give financing only to certain sector, because different sector, they provide different risk to the bank. Okay, they should not focus into one customer. Okay, one category for a customer. Okay, they should not only give financing to certain categories of customer. Okay, certain sector of the customer, they have to diversify. Why? In order to minimize risk, because different sector will provide different level of risk to the bank. Okay. All right. Next. This concept of risk management is also further supported by several hadith by Prophet Muhammad SAW, and also a number of legal maxims derived from it as follow. For example, Prophet Muhammad SAW said, once as a Bedouin who has left his camel untied, why do you not tie the camel? We cannot simply put trust or just leave it everything to Allah, but they have to make sure that they have certain alternative or certain effort in order to avoid any risk, something that we can avoid, so we try to avoid. Okay, so in terms of legal medicine, harm must be eliminated. Okay, in Islamic bank, they cannot simply eliminate, they cannot totally eliminate the risk, but they can try to minimize something that may affect the bank. Okay, maybe they can minimize, they can manage, or they can avoid from involved in that particular activities. Alright. So there is other hadith and also legal maxim that stated that Islam are not restricted for the Islamic banking institutions or business in order to manage the risk, but Islam also encourage any Islamic banking institutions, any business to minimize the risk, not only focus to the not only rely on the Allah Subhanahu wa Ta'ala. Okay, finally, we can see that it's a risk in Islamic banking institution where we can categorize the risk, or we can classify the risk, okay, systematic risk, unsystematic risk, and combination between systematic and unsystematic risk. Okay, so we have 4 categories of risk that are exposed by the bank. For example, business risk, governance risk, financial risk, and also treasury risk. This is all the different categories of risk that faced by the Islamic banking institutions. Alright. Okay, that's all for the lessons. Okay, we continue with the group activities. Okay, Assalamualaikum warahmatullahi wabarakatuh.